All right, we're looking at the Alex Johnson case study. Let's scroll down and read question 1. On a particular trading day, the MFTM ETF's average bid price is 50.05 and the average ask price is 50.15. The bid-ask spread and the spread percentage based on the ask price are closest to. So we actually don't need to do any reading for this. We can calculate the spread and spread percentage just based on everything that's given in here. So the spread itself is just going to be the ask minus the bid. So it'll be 10 cents. So we can cross off C there. So we've got 10 cents in A and 10 cents in B. And the spread percentage, I'll pull that in here. That's going to be the spread divided by our bid price, or our ask price, sorry. So we've got since it's based on the ask price. So we'll do 0.1, our 10 cent spread divided by that ask price of 50.15, which gives us 0.2%. So we will go with answer A. Question 2, if the secondary market trading price of MFTM is 50.5 while NAV is 50, what is the ETF trading at? Additionally, would this scenario typically lead to creation or redemption activities? So let's start reading a little bit just to get more information on this ETF. I think, like last question, we might not need any more information, but let's start reading. Portfolio manager Alex Johnson helms the Equity Growth Fund, a well-established fund with a strategy poised on capturing high-growth opportunities across various sectors. Despite the fund's strong focus on individual stock picking, Alex is contemplating integrating ETFs into her investment strategy to gain broad market exposure and sector-specific plays. Before making any concrete decisions, she decides to do a deep dive into the mechanics, trading, and application nuances relative to ETFs. Alex's team have pinpointed MarketFlex ETFs Incorporated as their go-to ETF provider, considering their diverse offerings and robust tracking accuracy. MarketFlex has recently launched an ETF, the MarketFlex Total Market, designed to mimic the performance of the Total Market Index, representing 98% of all publicly traded securities in the U.S. It features a competitive fee structure and has a creation unit size of 100,000 shares. Alex notes the importance of understanding creation redemption mechanisms offered by MarketFlex, the expected liquidity of MFTM in secondary markets, and how its bid-ask spreads compare to the underlying securities within the total market index. Despite robust performance tracking, Alex is aware of potential tracking errors that may arise from rebalancing discrepancies, dividend reinvestments, and underlying cash holdings. While the MFTM ETF trading near its NAV, with the ETF trading near its NAV, she remains vigilant about the prospects of premiums or discounts that may emerge in different market scenarios. So that's kind of what we're looking at here. We're wanting to know whether we're trading at a market premium or a discount. So if we're trading at a price above NAV, that means that we're trading at a premium. So we can go ahead and cross off C since this is indicating a discount. So then we need to know what this typically leads to, whether that leads to creation activities or whether that leads to redemption activities. So when we're trading at a premium, this is going to incentivize our authorized participants to engage in creation activities, because essentially what they're going to be able to do is they're going to be able to buy this ETF at $50.5, but the underlying securities are only worth 50. So they can buy those underlying securities for 50 and then sell them through the ETF via creation and make that 50-cent spread, basically. So this is going to cause those. This is how the market works, essentially. So that causes those that spread to converge, and so that's why ETFs generally trade near their NAV. But anyway, long-winded answer to kind of say that we have a 1% premium, and we're going to have creation activity because of that. Answer A. Question 3. Alex learns the MFTM ETF incurs an expense ratio of 0.1% annually. If the fund invests $10 million in MFTM, the annual management cost would be closest to. Nice quick one for you here. We're going to just do 0.1% or 0.001 times $10 million allocation gives us annual costs of $10,000. Answer B. Question 4. MarketFlex reveals that there was a significant redemption of MFTM shares leading to a temporary discount to NAV. What risk does this highlight and how might Alex mitigate it? Let's finish reading here. I think we read to about here. As with any investment, Alex knows the importance of considering ETF-related risks such as liquidity under stress scenarios and the costs associated with owning and trading ETF shares. Alex's fund typically holds a large position, say $10 million, in selected investments, and she is assessing how this would translate to trading in MFTM ETFs, both in terms of shares to be bought, associated costs like the expense ratio, and potential market impact. Additionally, Alex is curious about the tax efficiency of ETFs in comparison to mutual funds due to their unique creation and redemption process. So there's a significant redemption leading to temporary discount. What risk does this highlight? So a redemption is basically, this is going to cause selling pressure. And this is going to cause, if there's a large redemption of the ETF is going to have to sell underlying shares as well to meet those redemptions. And so basically, if those underlying securities are not super liquid, think something like microcap or small cap stocks. If the daily volume in those stocks is not liquid, then the ETF selling pressure is basically going to lead to market impact on those underlying stocks. And so basically, what risk does this highlight and how Alex might mitigate it? Market risk, mitigated by diversifying across different ETFs. That's not the risk we're looking at here because the risk is happening due to a large redemption, not anything that's happening in the market. B, liquidity risk mitigated by setting stop loss orders. And C, liquidity risk. So we're looking at liquidity risk here for 2 different reasons. Stop loss orders aren't going to help if the underlying isn't liquid enough. The price is just going to fall right through that order before you get filled. So then liquidity risk mitigated through due diligence on the ETF's underlying securities. That's correct. If you're going to be trading huge volumes in these ETFs, you want to make sure that you're not going to make any price impact on what you're doing. And this is why you see a lot more ETFs, especially actively managed ETFs in the large cap space. There's just a lot more liquidity in those underlying securities, so you don't have to worry about price impact. So we'll go with answer C.